Somewhere in your paperwork is a date, not your birthday, not a bill due date, a date attached to your mortgage that most people can tell you roughly but not exactly, and that single piece of vagueness is going to cost the average UK homeowner thousands of pounds this year. That date is the end of your fixed rate, and unlike almost every other financial deadline in your life, nobody sends you a loud, unmissable warning when it arrives. It shows up quietly, buried in a letter that looks like every other piece of mortgage correspondence you have ever ignored, and if you do not act on it yourself, your lender will act for you, automatically and not in your favour. I have been tracking the UK property and mortgage market for years, and the fixed-rate cliff edge is one of the most predictable, most preventable, and most commonly missed financial events in the entire homeownership journey. In the next few minutes, I'm going to walk you through exactly what happens the moment your fix ends, why the default outcome is deliberately built to benefit your lender rather than you, and precisely what you need to do and by when to make sure you are not one of the hundreds of thousands of borrowers who let this happen to them every single year. Let's start with the scale of this because it is far bigger than most people assume. Millions of UK fixed-rate mortgage deals were taken out during the historically cheap borrowing years of the early 2020s, the vast majority on 2- or 5-year fixes, which means an enormous concentrated wave of expiries is working its way through the market across 2026 and into 2027, month after month, borrower after borrower, almost all of them facing some version of the exact same silent cliff edge. Industry estimates repeatedly describe this as one of the largest waves of mortgage renewals in a generation, arriving at a moment when the gap between the rates people locked in years ago and the rates available today is unusually wide, which makes the financial stakes of getting this renewal process right or wrong considerably higher than in a normal, calmer market. Let's start with the basic mechanics, because a surprising number of homeowners do not actually understand what a fixed-rate deal is doing behind the scenes. When you take out a mortgage, you are not simply agreeing to a single interest rate for the life of the loan. You are agreeing to an initial deal, typically fixed for 2, 3, 5, or occasionally 10 years, that sits on top of a much longer underlying mortgage term, often 25, 30, or even 35 years. The fixed rate is a temporary arrangement. It was never meant to be permanent, and your lender has always known from the day you signed exactly when it would end. You, on the other hand, signed that paperwork years ago during one of the most stressful and expensive periods of your life, moving house, coordinating solicitors, packing boxes, and the exact expiry date of your fix is precisely the kind of detail that gets mentally filed away and forgotten the moment the removal van pulls off your old street. Here is what happens on the day your fix actually ends, because this is the part that catches people out. Your mortgage does not pause, it does not default, it does not require you to do anything at all in order to keep functioning. The moment your fixed period expires, if you have taken no action, your mortgage automatically rolls onto your lender's standard variable rate, commonly abbreviated as the SVR. This is not a penalty rate in the technical sense, it is simply the rate a lender charges when there is no special deal in place. But in practice, it behaves exactly like a penalty rate, because it is almost always significantly higher than any fixed or tracker product that same lender would offer a new customer, or that same lender would offer you if you simply asked for a new deal. Standard variable rates in 2026 are commonly running several percentage points above the best available fixed rates on the market. On a £250,000 mortgage, the difference between a competitive fixed rate and a lender's standard variable rate can easily add £400 to £700 a month to your payment without a single email, phone call, or letter demanding you approve the change. It just happens. To make this concrete, consider a borrower who took out a £250,000 mortgage on a 5-year fix several years ago at a rate that felt entirely normal for the market at the time. Life moves on, a promotion, a new baby, an aging parent needing more attention, and the exact expiry date of that fix simply stops being something they think about day to day. The fix ends quietly on an ordinary Tuesday in the middle of an ordinary month. No fanfare, no red letter, just an automatic switch in the background of the lender's own systems. The following month's direct debit goes out as normal, just for a noticeably larger amount. And because so many household bills fluctuate slightly month to month anyway, energy costs, a larger supermarket shop, a one-off expense, the increase does not immediately register as anything unusual. It can take 2, 3, sometimes 4 monthly statements before the pattern becomes impossible to ignore, by which point the borrower has already handed over a genuinely significant, entirely avoidable sum simply because nothing about the transition was designed to interrupt their attention at the moment it actually mattered. Red flag number 1, the silent default. This is the single most important thing to understand about how this system is designed. Your lender is under no obligation to get your active, explicit agreement before moving you onto the standard variable rate. The mortgage contract you signed years ago already authorized this exact outcome as the default behavior of the loan. Your lender will typically send you a letter, sometimes multiple letters, in the months leading up to your fix ending, informing you that your deal is expiring and inviting you to arrange a new one. But a letter sitting in a pile of post or an email filtered into a folder you never check does not constitute meaningful notice in any practical sense, and lenders know this. The system is built so that inertia, not malice exactly, but structural inertia, works entirely in the lender's financial favor. Every borrower who simply does nothing generates additional interest income for their lender at no additional cost or effort to that lender whatsoever.
Red flag number 2, the notice period illusion. Lenders will often point to the fact that they send renewal reminders, sometimes as early as 6 months before your fix ends, as evidence that borrowers have ample warning. In practice, this notice period does very little to protect people for a simple reason. 6 months feels distant, unimportant, and easy to defer when it arrives, particularly if you receive it during a busy period of life, a new job, a new baby, a family illness, exactly the kind of ordinary life circumstances that make financial admin feel like the least urgent item on a long list. Brokers report that the majority of new business they write comes from borrowers who are already within 1 to 2 months of their fix ending, often after receiving a second or third reminder letter that finally cuts through, or in a meaningful number of cases, after already rolling onto the standard variable rate for 1 or more months and receiving a shockingly higher bank statement that finally forces the issue. Red flag number 3, the false safety of a good credit file. A lot of borrowers assume that because their finances are in order, their income is stable, and they have never missed a payment, arranging a new deal when their fix ends will be straightforward and can be left until the last minute. This assumption is increasingly dangerous. Mortgage affordability rules have tightened meaningfully over recent years, income verification requirements have become stricter, and a borrower who easily qualified for a mortgage several years ago is not automatically guaranteed to qualify for the same loan amount today, even with an unchanged income, because the underlying affordability calculations lenders use have themselves shifted. Waiting until the final weeks before your fix ends to start the renewal process means that if you do run into any affordability complication, whether that is a change in employment status, increased existing debt, or a property revaluation that comes back lower than expected, you have almost no time left to address it before you fall onto the standard variable rate by default while you sort out the problem.
Red flag number 4, the remortgage versus product transfer confusion. When your fix ends, you generally have 2 distinct paths available, and most borrowers do not understand the meaningful difference between them. A product transfer means staying with your existing lender and simply switching onto a new fixed or tracked deal that lender is currently offering, typically a faster, lighter touch process that does not require a full new mortgage application or a fresh valuation. A full remortgage means either switching to an entirely new lender or restructuring your existing arrangement more substantially, which usually does involve a fresh valuation, a full affordability assessment, and considerably more paperwork. Borrowers who assume these 2 paths are interchangeable or who default to the product transfer route purely because it is easier and faster frequently miss out on better rates available elsewhere in the market, because your existing lender's product transfer rates, while convenient, are not always competitive with what a genuinely new application to a different lender could secure. The comfortable, low-friction option is not always the cheapest one, and lenders are fully aware that inertia pushes a meaningful share of borrowers toward the product transfer path purely because it requires less effort, even when it is not the best available deal. Red flag number 5, and this one connects directly to something I have covered in previous videos on this channel, the revaluation risk sitting inside every remortgage. If you choose the full remortgage path rather than a simple product transfer, your property will typically be revalued as part of the process, and as I have discussed before, revaluations in 2026 are frequently coming back lower than owners expect, particularly for flats. A lower than expected valuation at the exact moment your fix is ending can push you into a worse loan-to-value
band than you were previously in, meaning even the new deal you eventually secure may come with a materially worse rate than you were hoping for, purely because of a valuation figure you had no visibility into until the process was already well underway. This is precisely why leaving your renewal until the final few weeks is so risky. If a low valuation does land, you have no time left to shop around, challenge it, or explore alternative options before defaulting onto the standard variable rate anyway.
Red flag number 6, the early repayment charge trap at exactly the wrong moment. I have covered early repayment charges in detail in a previous video, but they deserve a specific mention here because of how they interact with renewal timing. Most fixed-rate deals carry an early repayment charge if you leave before the fix naturally ends, and that charge typically only disappears in the final weeks or months before the deal expires. Some borrowers, anxious about rising rates, try to lock in a new deal too early, sometimes many months ahead of their actual expiry date, without realizing their current lender will still apply the early repayment charge if the switch completes before the fix has technically ended. Understanding your specific product's early repayment charge taper and the exact date it drops to zero is essential to timing a renewal correctly. Locking in a new rate early enough to avoid the standard variable rate gap, but not so early that you trigger an unnecessary penalty on the deal you're leaving. Red flag number 7, the rate lock window that most borrowers do not know exists. Here's something genuinely useful that a large number of homeowners are simply unaware of. Most lenders allow you to secure or lock in a new mortgage offer for a future start date, commonly somewhere between 3 and 6 months ahead of your actual fix expiry, at a rate agreed at the point of application. If rates rise between the point you lock that offer in and the date it actually starts, you keep the lower rate you secured. If rates fall in that window, many, though not all, lenders will allow you to switch to the lower rate closer to completion. This mechanism exists specifically to let borrowers protect themselves against exactly the kind of uncertainty covered in this video, and yet a meaningful share of borrowers do not act until their fix has already ended, missing the opportunity to lock in a rate months in advance entirely by accident, simply because nobody explained to them that the option existed that early.
Red flag number 8, and this one is subtle but genuinely important, the framing of the renewal letters themselves. When lenders write to inform you your fix is ending, the tone of these letters is typically calm, procedural, almost bureaucratic in nature, using phrases like, "Your current deal is coming to an end and here are your options," rather than anything that conveys genuine financial urgency. Compare that tone to how a bank communicates when you are close to exceeding an overdraft limit or when a credit card payment is about to be missed, communications that tend to be considerably more direct, more frequent, and more attention-grabbing. There is no suggestion here of any deliberate manipulation in how these letters are worded, but the practical effect is the same regardless of intent. A calmly worded procedural letter about a rate change that could cost you hundreds of pounds a month simply does not generate the same urgency in most people's minds as a letter warning about a missed payment, even though the financial consequence of ignoring it can be considerably larger over time. Now, here is the part that connects all of these red flags together, and it is worth saying plainly. None of this is technically hidden. Every one of these mechanisms is disclosed somewhere in your original mortgage documentation, and every lender will confirm, if asked directly, exactly how their renewal process works. But disclosure is not the same as communication, and a system that relies on borrowers proactively reading 40-page documents years after signing them, remembering an exact expiry date buried among dozens of other numbers, and initiating contact months in advance is a system that predictably, reliably, and repeatedly benefits the lender at the expense of the borrower. Every single time, inertia wins.
I spoke with a mortgage broker about this specific issue, and off the record, her assessment was blunt. She said the single most common phrase she hears from new clients is some version of, "I didn't realize it had already ended." Not, "I forgot my fix was ending soon," but "I didn't realize it had already ended," meaning the borrower had already been paying the standard variable rate, sometimes for 1 or 2 full months, before they noticed their payment had increased and finally investigated why. She said in her experience, this happens most often to borrowers who have their mortgage payment collected by direct debit and simply do not scrutinize their bank statement closely enough month to month to notice a payment increase that arrived without any accompanying explanation landing in their inbox at the same moment. by the time they call a broker, they have often already lost hundreds of pounds to a rate gap that a single calendar reminder set years earlier on the day they signed their original mortgage offer would have completely prevented. She added that the financial impact of this is rarely limited to a single missed month either, because once a borrower has fallen onto the standard variable rate, arranging a new deal is not instantaneous. Even a straightforward product transfer can take a couple of weeks to arrange, and a full remortgage considerably longer, meaning a borrower who notices the problem a month late might realistically be exposed to the standard variable rate for 6 to 8 weeks in total by the time a new deal actually completes, turning what felt like a small oversight into a genuinely significant unplanned cost, often running into several £100 or more by the time the new, cheaper rate finally takes effect. So what do you actually do about this? Here is the practical playbook. First, right now, today, find your current mortgage offer document and locate the exact date your fixed rate ends. Not the year, not the approximate month, the exact date. Second, set a calendar reminder, or better, several calendar reminders, at 6 months, 4 months, and 2 months before that exact date, because a single reminder is easy to dismiss, while a repeated one is much harder to ignore. Third, roughly 6 months out, contact a whole-of-market broker rather than going directly to your existing lender first, because a broker can quickly tell you whether your existing lender's product transfer rates are competitive or whether a full remortgage to a different lender would genuinely save you more, and can also tell you whether locking in a future rate now makes sense given current market conditions. Fourth, ask specifically about your product's early repayment charge taper schedule so you know the exact date any penalty for switching early disappears, allowing you to time a full remortgage correctly if that turns out to be the better path. Fifth, if you are choosing the full remortgage route rather than a product transfer, start that process with enough runway, ideally 4 to 6 months, to absorb any delay caused by a lower than expected valuation, additional underwriting questions, or a slower than usual conveyancing chain, all of which can eat into your timeline faster than most borrowers expect. Sixth, if for any reason you do end up rolling onto the standard variable rate even briefly while a new deal completes, ask your broker whether your new lender's offer can be backdated or whether any product transfer options allow same-day switching once your existing offer completes, since some lenders can move borrowers off the standard variable rate the moment paperwork clears rather than requiring you to wait out an additional full billing cycle at the higher rate. Seventh, if you have a partner or joint mortgage holder, make sure the expiry date and the renewal reminders are shared between both of you rather than sitting only in one person's calendar or inbox, because a surprising number of missed renewals happen simply because each partner assumed the other one was handling it, particularly during busy periods when household admin naturally gets divided up and details fall between the cracks. Eighth, if your circumstances have changed at all since you last took out a mortgage, a change in employment type, a new source of income, a change in household composition, mention this proactively and early to your broker, rather than waiting for it to surface during underwriting, because giving yourself extra time to address any complication a lender might raise is precisely the advantage that renewing early, rather than at the last minute, actually buys you.
Here's how I expect this to play out across the market over the next few years. As the volume of fixed-rate deals originated during the historically cheap borrowing years of the early 2020s continues working its way through to expiry, expect renewal activity and renewal-related complaints to remain elevated well into 2027. Expect brokers to continue reporting that the majority of new client inquiries arrive later than ideal, because behavioral patterns around financial admin change far more slowly than market conditions do. Expect continued calls from consumer groups for lenders to send renewal reminders further in advance, in plainer language, and through channels borrowers are more likely to actually notice, a text message rather than a letter, for instance, though based on how these kinds of consumer protection changes have moved through the industry historically, meaningful reform here is likely to arrive slowly if it arrives in a standardized way across the whole market at all. And expect the gap between the most switched-on borrowers, the ones who calendar their expiry date the day they sign and engage a broker 6 months out, and the least switched-on borrowers, the ones who discover their fix has ended only when a bank statement looks unusually large, to keep widening. Because in a market where rates and lending criteria shift constantly, being early with your renewal is not just a minor convenience, it is a genuinely significant financial advantage that compounds every single month you act ahead of the deadline rather than behind it. There is also a broader shift worth watching here, connected to something I touched on in an earlier video about lenders quietly maintaining internal restricted lists for certain postcodes and buildings. As more borrowers approach renewal during a period where property valuations in some areas are coming in lower than expected, and where a growing number of buildings carry one flag or another, cladding, insurance availability, service charge disputes, the intersection between the fixed-rate renewal wave and those property-level restrictions is likely to become a more visible problem over the next couple of years. A borrower who assumes their renewal will be straightforward purely because their personal finances are strong may still run into difficulty if their specific building or postcode has quietly become harder to lend against since they last applied, which is exactly why starting the renewal conversation early, with enough time to explore alternative lenders if your first choice proves difficult, matters even more for owners in flats than it does for owners of standard houses in unflagged areas.
It is also worth mentioning how this renewal wave interacts with household budgeting more broadly. A payment increase of several £100s a month rarely arrives in isolation. It lands at the same time as ordinary cost of living pressures, energy bills, food costs, childcare, all of which have their own upward trajectory regardless of what is happening with your mortgage. Borrowers who model their new payment early, well before their fix actually ends, give themselves the chance to adjust other areas of household spending gradually, in a planned way, rather than discovering the full scale of the increase only when it has already landed and adjustments have to happen immediately and under pressure. This is a small point, but it is one brokers consistently raise as the difference between clients who navigate a renewal calmly and clients who experience it as a genuine financial shock, even when the underlying numbers involved are ultimately quite similar. The uncomfortable truth underneath all of this is that your fixed rate was never actually fixed in the way the word implies to most people when they sign the paperwork. It was a temporary shelter with a clearly defined, contractually agreed expiry date that your lender has known since day one and quietly benefits from you forgetting. Nothing about this system requires you to be a financial expert to protect yourself against it. It requires exactly one piece of information, the precise date your current deal ends, and exactly one habit, acting on that date months before it arrives rather than months after. If there is a single action to take away from this video, it is this. Stop what you are doing after this video ends, find that date, and put a reminder in your calendar right now, because the single most expensive financial mistake in UK home ownership right now is not a bad decision, it is simply forgetting to make one at all. Every borrower currently sitting inside an active fixed-rate deal has, right now, the single most valuable piece of information they need to avoid all of this, an exact expiry date already written down somewhere in paperwork they already possess. Nothing about protecting yourself here depends on predicting where interest rates are heading, understanding complex mortgage products, or having any particular financial expertise at all. It depends entirely on treating one specific date with the same seriousness you would treat a tax deadline or a renewal notice for something you genuinely cannot afford to let lapse, because in practical terms, that is precisely what this is. The lenders are not hiding this information from you, they are simply relying, reliably and repeatedly, on the fact that most people will not go looking for it until it is already too late to act on it cheaply. And every year that reliance quietly pays off for lenders at the direct expense of otherwise careful, responsible homeowners. Do not be one of them.